All right, there we go. My name is Daniel Young. I'm the owner and founder of Adaptive Perspective and the Adaptive Perspective social media platforms. This video continues my use advocating for closed-end funds in our investment strategy. Uh, if you want the full methodology and our full 12 steps to financial freedom, then head over to Facebook and check out my page there called Adaptive Perspective, Navigate Your Finances, where I give you the entire framework for free. So this is an unedited video. Who knows what you'll hear in the background as I film these in my house. I am not a financial advisor. I am a financial strategist, and I don't speak like the herd. I walk in limited company, and sometimes I walk alone. Uh, I actually saw a really nice meme on this. Uh, it, if you follow the herd, all you see is buttholes, and on sheep, it's kind of a dirty butthole. So I don't speak like the herd. Uh, so compared to the last video, I can actually talk now. When my favorite and only paid for service, Brett Owens and the Contrarian Outlook, along with all the other financial advice services, all say the same things, there is blood in the water. And we're finally seeing that olfactory deprived pig sniff out a truffle too. So if you've watched my videos, what have we been targeting? Bonds, tech, utilities, energy infrastructure, oil, right? If you can find those things cheap, real estate, because everybody's still dogging real estate. But what is everybody else saying right now? Bonds. But why would they say that? Well, the Fed has more than hinted it's going back into the obvious printing mode as opposed to the quiet printing mode. And they're juicing the rates. And despite inflation still being up, and despite you and me knowing that inflation is still up, the Fed is signaling a rate cut on our horizon. It's imminent. I don't know if it's going to happen this month or next, but it's here. And the way it's been, I mean, every one of us would love a rate cut sooner than later. Um, but it seems that that is on our horizon. So the market is hopeful. So which areas of the market would do best with a rate cut? And the easy answer is all of them. Um, but which would be poised to do the best? So when rates go down, bond prices go up. They are inversely tied. So if you can snag a deal on a bond right now, then you would get a better profit when the rates drops, right? So bond prices, uh, whether you think that's value and worth, but bond prices go up and rates go down. So where do we look? Um, Outside of Brett Owens, most people are going to point to the bigger names in closed-end funds and ETF guys in general. But ETFs aren't my game. And the big guys in the closed-end fund world, like Jeffrey Gundlach and AWF, Gundlach is for like DLY, DSL. We own DSL, but those aren't good options right now because they're not selling for historic discounts. So if those guys aren't the option, then we're just going to keep sifting through the honestly just other great companies that we've been sifting through and talking about. It's just they're not well known. So it boils down to this. So obvious quantitative easing, printing money, plus a rate cut equals a rising bond price and bond profit near or at the start of the presidential race because the Fed wants to sell itself as doing a damn good job. So that's when everybody's watching the presidential race, you should expect the Fed to be like, hey, we're doing a great job solving the problem we created. And I mean, better prices and profits are great, but we're not in it for the short run. We're playing the long game. So that relates to the Fed meddling, but isn't dependent upon the Fed meddling. So if you remember Kiyosaki's advice, it's buy what the Fed cannot print. So if you're investing where the Fed is printing money, then when they devalue currency, then your profits are going to drop off because your profits are devalued. But if you're buying what the Fed cannot print, then you're buying oil, you're buying tech, which is an oil derivative, You're buying real estate and you're buying bonds. And currently, oil and energy infrastructure, utilities, et cetera, that's all surging. I mean, you can get it at a discount, but you're also paying more for it now than you were a year, really 6 months, a year, or 2 years ago. So you can buy it and get a great discount, but price wise, it'll be higher than what it's been. Tech is still inflating that bubble. You can get it cheap. Like we own NBXG, which is 5G technology implemented across companies. Um, they're investing for the future, right? Into 5G tech. So you can get it cheap, but that price is also on the rise. I think it's risen 60 cents alone in the last 2 to 3 weeks. So it's cheap and the discount is great, but it's still more than what it's been. So if you bought it low and you bought it like if you'll see our portfolio in a second, if so we bought it at 11.40 inside the Roth, and now it's over $12. That 60 cents gap. If you buy an equal share of what you already bought, you've cut your profits in half. But at the same time, the price should still go up. So you're still getting a great deal. Versus if you're just buying it now, you're paying a higher price than what it was, but it should still continue to go up. So you'll still get a great deal. So I can make a case for that, but it's also more expensive to share the bond than some of the bonds we're really than all the bonds we're going to look at. And then of the four, so we got oil, tech, real estate, and bonds. Real estate is the dog, like everybody's dog in real estate. But if bonds are gonna, if we're gonna get an actual Fed rate cut and bond prices go up, a rate cut will also help real estate. It's just nobody's talking about it. So the current dip, I mean, so if I look at my notes and kind of get on and off track, it's real estate's worth a consideration, but the current dip before the next swell is in bonds. So when that wave passes, we'll look for the next best long-term play. And that means our overall strategy is intact. We're just looking at bonds and real estate, unless you choose to snag tech with NBXG or somebody else. And for us, as tempting as oil is, it's just not. And KYN is at a discount, but it's also $1.50 more than what we paid for it, which is not really like it's tempting, but I think our money is better placed at the moment. So let's see what the week has for us, and we'll go from there. So if you pause the screen, this is our Roth portfolio. This is everything inside of it. I want to say we bought this this week. Nope, this week. So filmed on 4/21, which was a Sunday. We bought on 4/22. Yep. And that's the current Roth portfolio. And we could look into the individual brokerage account, but it's not something we're going to invest into with bonds. Like we're looking at selling this company, which is now a mutual fund, was a closed-end fund, now a mutual fund. Um, Closed-end fund, now an ETF. And I actually like how it's performing. I'm all about closed-end funds, but this is riding the renewable energy and current utility and energy wave. So it's kind of like ride it till it's about to flounder and then sell it. Uh, but if we look at the master, since I was looking at this earlier, we it, oh so all right, so everything in gray doesn't meet the standard. Olive color is tracking. Purple is recommended by somebody. Medium blue is inside the Roth, and light blue is inside the individual brokerage. Uh, y'all have seen me explain these targets before. Um, Triple target is uh, significant difference in its individual pricing. So it's the historical data for this one fund related to this one fund and not all the others. Uh, Double asterisk is dollar cost average for us, and then a single asterisk is tracking, but not on the buy list right now. So if we take this top batch, copy it, we're going to further filter it on this video. Current would apply to us of what we currently own. So dark blue we own, light blue we own, green we track for any number of reasons. Purple is someone has recommended it of all the different advisory service emails I get. And all of these are significantly different per the data of each individual fund. So the easiest thing to do, we want consistent monthly income. Now, KYN is a energy transfer, just all around energy transfer company. And it pays a great dividend. Dividend will hopefully go up. It's I mean, still sub 10 per share, but it's also more than what we've paid for it. So, oops, it's that first three. There we go. Those guys are out of consideration. Next, we look at yield. I always like the inverse. So I want to take everything that's sub 9% out. The two exceptions to this, well, really just the one exception. RMM is a municipal fund, and at $15 a share, it's a little rich, honestly. It is tax-free income. That's the tax equivalent for our tax bracket. And yes, it's sub 9% yield, but it would be greater than that because it's tax-free. But at the same time, it's not going to make the cut. HFRO will, primarily because, well, we'll say two reasons. Primarily because of the discount. It's the greatest discount. You're still getting it for like 50 cents on the dollar. So if 0% is a dollar, let's see if we have a 0%. That's close. Between these two, that's close. So if you put a dollar in, you're getting a dollar per share. If, like in this instance, it's almost, so that's almost 97, right? So that's like paying $1.97 for every share you buy. Versus this one is paying 50 cents for every dollar invested. Or I guess 51 cents now. So, but the other is, I mean, the guy who runs it does a phenomenal job. It looks to the fears for that closed-end fund and what they own and how they do seem to be overblown. And I think the dividend will come back. So it will stay on the list. All right. So if we filter out everything there, so I'll put it this way, if the dividend comes back, they cut the dividend in half. They went from primarily bonds to primarily real estate. So if the dividend comes back, that's what the dividend would be. That's what the dividend would be based upon what the dividend used. That won't make the cut anyway. So that leaves us with this. I've said this before. I track these funds because I'm interested, but the consumer market is way too can't think of the word now. I can't think of the word. That's crazy. It's way too convoluted, but that's not the right word I want. But it's way too chaotic. So that leaves us with what we already have. Facts, I don't like long term. Aberdeen, we used to own a lot of Aberdeen funds, and then we inherited Aberdeen funds. I'm just not impressed by their management style. For a Pacific Rim bond fund, and yes, you can argue for and against the Chinese economy, but with the just exploding Chinese economy, it's not a fantastic bond fund. It pays a consistent dividend. I like the consistent dividend. I just wish the share price also reflected that. Now, yes, everybody's rates have increased. So in theory, the price should raise, right? So the bond price should go up when rates drop. We'll see. Uh, but long term, my plans for this company are to sell it. So that leaves us with this. And based upon the Roth, which is here, let's look. So you have bonds, bonds, or actually over here. So we have bonds and other assets, US only, corporate bonds, real estate, some bonds, infrastructure, bonds, real estate, loans, which are kind of like bonds, but this one's out of contention for the week. And then here you have 5G tech. So if you look at what we have of what makes the cut, now this is just me cutting companies, and this is what's left. You've got bonds and loans. You've got that same thing, right? Energy infrastructure, bonds, real estate. You've got all American bonds, corporate. You've got 5G tech, and now you've got real estate. So in comparison, I can make an argument for buying another 50 set of NBXG because we already own it. But if you buy, and you could make the argument that the price is going to go up. So for you, this would be buying it on the lower side. But in comparison to everything else on the list, I mean, it's almost double what we could pay, what we could make for bonds. So it comes down to your strategy. All of these are at play in the current economic market, and all are at play in great investments for the future. So it really does come down to your strategy and what you have. These are sister companies. So what we have is this. Not 20. I buy in sets of 50. And this is kind of a mix of strategy. So my current thoughts are these. This is a non-traded company now on our Webull platform. So it tracks price, but it's not like I can sell it, but I can't buy more of it. And I honestly don't want to buy more of it because it's a mutual fund. And our thing is closed-end funds. So I don't know when the next time this company will pay a dividend. Based on what I can find on the online investor, they paid a dividend in March. So maybe it's still a category 3 dividend payer. But the dividend they're paying now is like less than 3%, which before this was almost, I mean, we were looking at, yeah, like almost 11.5%. So, and I get that skewed because this is skewed. But it was like a good 11, 12% dividend pair. So to go from that to below inflation and not being an actual traded fund on our platform, I'd honestly rather sell it because we can reinvest the money and make better money on the front end now going forward. Uh, so this is an estimate of what we have available, but based on the other one, you could say that we've got, oh, not 20. It's like we have that available. So based on that, I mean, yeah, we could snag everything, right? But if we sparsed it out a little bit more, what would we buy? I mean, that mutual fund is heavy tech, so I could make the argument to go from heavy tech investment to heavy tech investment. But I think for these purposes, with as many people signaling bonds as there are right now, I think as tempting as tech is, uh, I still got to lean more on the bonds and real estate. So it comes down to strategy and where you want to put your money. Global, all American. Real estate, kind of a mix of things. And it's a bigger mix of things than it used to be. Uh, when it was heavy into these three, I favor that strategy. They've branched out and diversified more, which you can argue for and I could argue against. That's neither here nor there. So I like this company. Uh, I honestly wish that me personally, I wish they had not diversified as much. Uh, it's also, yep, no, there we go. It's about 40, 50 cents up of where we bought it. Um, so if I streamline this and take this one off, we're left with this. So equals that minus the sum of these things. So as you enter your shares, it'll automatically tell you what you have left. So you look at Global Fund, the guy that owns this fund also, so he's a billionaire and like a billionaire hedge fund guy, and he's taking over companies and championing how well they pay their shareholders. I like that. He's also taking on BlackRock, not by means of outright buying BlackRock himself. He's using his closed-end funds to buy the majority shares in BlackRock to where he can now challenge them to do the same thing. And you can guess that BlackRock doesn't like that. This platform I use, or Nuveen's platform, where I get a lot of, where I really get all of the closed-end fund data, has taken off BRW and SABA, those two, I want to say it's Boaz Weinstein. They've taken off his funds off their platform. So I now have to go somewhere else to get data on the closed-end funds because according to CEF Connect, those funds don't exist anymore, which tell me that he's fighting a lot of different people. So I like that mentality. Um, I don't like BlackRock, but I like that somebody has the stones to actually take them on and force a change. That's nice to me. Uh, so pending how the pricing of everything goes, a 50 spot in each of them leaves us negative. But that comes down to the pricing of things, right? So if things change, you can easily pick up a set of 50 of each. But it really just depends upon the pricing of things. It also depends upon you. I like an all US, all American company because regardless of what you think of the economy, it's one economy and it's not dependent upon those weird swings we see in a global market. And this one will swing because it's America and abroad. Uh, and I also still like the real estate play because even though they're not bonds, loans are very similar to bonds, and we all get the real estate game. So long as the Fed keeps the interest rates where they are, it's really hard to find a new house. It's really hard to move because rates are at 5.5%, 6%. But if they cut rates by a quarter to a half percent, that still might put you out of the market for a house. But it changes the mentality inside the real estate market to where people now want to move. Um, so I like the play, even though real estate is still dog. So those are my top three for the week. And I get it. It's negative, but it still depends upon the price swing. I mean, a couple cents forward, a couple cents back, and you can easily score those three for 1,000, really for under 1,000, depending on where they swing. So that's all I got. Um, it the biggest thing for you is regardless of take, like regardless of my take or any of the people I read, you need to know your strategy. I love Brett Owens, but we differ sometimes, and that's okay. Like I love his advice. I like to be challenged. It makes me think. Um, and it forces me to evaluate our strategy and what we're doing. But you can disagree with people. Then quite honestly, I still pay for his service because I like his advice. So regardless of who you follow, regardless of what everybody says, you need to know your strategy Because if you have no strategy or have no idea what your strategy is, you're very easy to sway one way or the other. And you don't want to be like that. I mean, you can be like that. It's your choice. Like it's you, the person. But I would encourage you to know your strategy, know where you're going, know what you're doing on the for the long run, know what your play is. Our play is yes, we want all those companies to increase in value. That's what you want on an investment. But we also want to supplement our retirement on dividends. And inside that Roth, it's tax free. And it's tax free money. It's if you pull the money out early, yes, you pay penalties. But so long as you jump through the hoops, so long as you jump through the hoops, the dividends, the increases, whatever money you take out, so long as you jump through the hoops, is tax free. It's not tax deferred like a 401k. It's tax free. So our goal is to supplement or fund a retirement on dividends. And that's feasible inside a Roth. It's also feasible inside of an individual brokerage account, but all your dividends are taxed on capital gains. And when we did the math online, just in basic math online, it was a good $30,000 difference in taxes over time between the individual brokerage and the Roth account. So we picked a Roth. We picked a hybrid form for the moment because I think we're going to end up with real estate and energy inside the individual brokerage long term until those cycle back to going down again because everything is cyclical. Some just take a lot longer to happen. But I think long term we'll end up with two funds. And then when energy is kind of on its downward spiral again, we'll sell that stuff off, stick the money inside the Roth, and then just have the Roth account. So I say all that because your strategy is your strategy. You can agree or disagree with what I'm saying, right? But the important thing is you knowing what you want to do so that I'm not trying to twist your arm into investing in something. I'm telling you why I'm doing it and hoping it helps you and hoping it helps you think through what you're trying to invest in or what decisions you're trying to make. So those are my top picks for the week. If you like the content, consider subscribing to my channel. Hit the like button because it really does help push videos out. And then head over to Facebook and join my group there called Navigate Your Finances. And regardless of whether we agree or not, regardless of whether our dreams are on polar opposite ends of the earth, and regardless of whether we agree, I think maybe I already said that, I don't know, but regardless of that, it's you're the captain of your ship and you steer it. So you can either actively steer it where you want to go, or you can, I guess, inactively steer it and just let it float based on where the winds blow you and where the tide pushes you. And I would encourage you to be the captain your ship needs. Do the learning. Yes, there's a huge learning curve, but take it on. Like take on the challenge, learn, adapt, build a system, adapt the system, improve the system, and just continue learning as you go. But captain your ship, because if you don't, your ship will go wherever the winds blow it. Like you have all this ability and possibility and potential to control where the ship goes, to get from where you are to where you want to be and beyond. And by not actively doing it and just being pushed around and buffeted by the winds, you're being very passive when it comes down to your individual purpose and destiny. My advice, don't do that. Right? Because if it could have happened, if we could all do it passively and have our dreams land in our laps without any work, we'd all do it for the most part. Right? But if it could have happened on its own, it would have happened on its own, but it hasn't. So you have to make it happen. And you cannot make it happen when you are passively sitting on your ass, hoping the ship goes where you want it to go. So stand up and take the wheel and drive that ship from where you are to where you want to go and beyond. Right? Captain your boat. Make it happen. So that's all I got. I wish y'all a great week, and I will see you on another video. Bye bye.